AmBank Group's investors presentation for the third quarter, 9 months FY2012 results on the 14th of February 2012. I would like to call Mr. Chia to do the initial presentation. Mr. Chia.
Good afternoon. We are pleased to announce today the 9 months results for financial year 2012. This is the 20th consecutive quarter of reporting profits. As usual, we achieved double digits of 14%, improving the ROE. We also experienced a strong CASA growth of 20% amidst moderated loans growth to manage the net interest margin higher on quarter-on-quarter. The capital base is now positioned for Bank Negara Basel III guidelines and will meet our targeted payouts. Credit ratings, we're pleased to announce credit ratings, both the bank and the investment bank will be upgraded by S&P to BBB+, A2 and stable by S&P as mentioned. And of course, as we have announced, we have conducted due diligence to acquire a local general insurance company. On the numbers, which my colleague Ashok will get in greater detail, these numbers came right from very disciplined strategy execution, and these have been doing over the years. As I mentioned, PATMI is up by 14% compared to the previous 9 months, and if you compare to the third quarter, we are slightly down because of the strong non-interest income we experienced in the second quarter. The ROE is up, so as the numbers on ROA and earnings per share. On the various divisions on different lines of business, the markets of course experienced very strong growth, 0.3%, followed by corporate and institutional. The part that the insurance, the only line of business, life insurance, where we have a decline, largely as we have mentioned in the half-year results, is that we are putting greater increased focus on banker insurance and better performing agencies. If we look at the loans growth, net lending itself is 74.1 billion, up 6.6% against the 9-month period, and customer deposits up by 7.2% and CASA by 20%. On the capital and funding side, the gross impact loans ratio is 2.64, down from 3.35%. Risk-weighted capital for the 9 months is 15.1%. So it's Tier 1 capital and Common Equity Tier 1 8.5%. Loan deposit ratio remains roughly basically above 90% as the previous 9 months, and cost income ratio is 40.1%. What is lying ahead of us? Of course, we are fully aware that there's still the Eurozone crisis, and we will continue to face weakening external demand. Despite this downside risk from external sector, strong initiative from the ETP and the 10 Malaysia plan, as well as stable employment opportunities, will provide some support for private investment and consumption in the country. The GDP for 2011 is estimated to be about 5%, and 2012 is forecasted to be around 4%. From the industry side, as you're aware, Central Bank has introduced new macro-prudential measures, largely to rein in excessive consumer loan demand, and we also do not anticipate that interest rates will go up. We expect it to be maintained in the short term, while the mortgage loan demand and ongoing competition were likely to impair margins. The economic environment is likely to be tough, and this is of course putting pressure on asset quality. The central banks will announce 10-year financial sector blueprint, and it provides a further liberalization of financial services and framework for new products and services across all segments. As for AMMB, we will continue to implement our strategic initiatives. We will stay focused on growing sustainable non-interest income, CASA, and loans growth targeting viable and profitable segments. We expect subdued conditions, but the ETP and the budget will provide some balancing opportunities for all of us. We will continue to invest in infrastructure while maintaining high standards of governance and risk disciplines. As we announced, we want to take advantage of our international partnerships, and we focus on international connectivity for growth. The short-term outlook is cautious with downside risk. And with that, if I could ask Ashok to go into greater details.
Thanks, Mr. Chair. If I could take you through the slide 9, which is giving you the composition of our P&L, you can clearly see that non-interest income has been the biggest contributor for our revenue growth over the last 9 months, offset to an extent by what we've done on the expenses side through investments mainly, and provisions continue to trend downwards. Generally speaking, it's non-interest income and lower provisions that have driven our profit growth for the last 9 months. In terms of the divisional contributions, it continues to be well diversified, as you heard Mr. Chair talk about. Apart from life insurance, all the other divisions have shown a positive trend in terms of profit growth, and the composition continues to diversify away from retail, where we had some large concentrations 4 years ago, to one where we've got a much more balanced portfolio of businesses within the group. On slide 11, what's particularly pleasing is our net interest margins. You might remember that we surprised the market a little and surprised ourselves with the margin contraction that we saw in the very first quarter. We've since then taken a proactive approach to managing our margins, and we've done that even if that meant trading off some of the growth on the loan side. And as you saw Mr. Chair's presentation earlier, our loans growth is coming at a slower pace compared to the industry, but we preserved our margin and indeed improved it quarter on quarter over the last 3 quarters, and that's consistent with our strategy. In terms of the composition of the fee income, trading income, and the insurance businesses, you can generally see that they've all gone up in the last 9 months, albeit the trading income will continue to moderate after a particularly strong first half for us. On slide 12, you've got our asset quality trends, which continue to improve, both quarter on quarter as well as over the years. We do know that the short-term outlook might put a bit of pressure in terms of that improving trend, but nevertheless, we believe we've got the right measures in place to manage through a potential down cycle. And again, that down cycle is going to be more modest compared with what happened 3 years ago through the global financial crisis. And our provisioning cost at 53 basis points is roughly in line with our expectations and what we previously talked to you about. Our loan loss coverage continues to be healthy at above 100%. On slide 13, you can generally see that our loan loss, our gross impaired loans formation still continues to be okay, trending downwards after a particular issue that happened in the second quarter of this financial year. A particular large account turned impaired in business banking across the various facilities we had with them. Outside of that large one-off item, I think that the trends continue to be very strongly supportive of improving asset quality, and everything is within expectations on that side. We began our journey to grow our non-retail loans 4 years ago in a very strategic way. That trend continues today. Our growth, fastest growth, has come in from both the business banking and the corporate institutional banking segments, which is exactly in line with our strategy. We continue to ensure that where we compete in retail is one which gives us returns on equity that's positive, and that's increasingly hard in some segments within retail, and hence we've had continued slower growth in retail loans. But what's also particularly pleasing is the fact that our variable interest rate loans have continued to trend upwards, and today that constitutes 55% of our total portfolio. And that again means that in a balance sheet mismatch position, we do not have to hedge as much on the deposit side or with swaps and other derivative instruments to keep our overall value at risk within limits. Our funding profile continues to improve. On slide 15, you can clearly see that our trajectory around both term funding and individuals continue to track well. Our debt maturities are well distributed out into the future. Hence, we would not be reliant on any particular year for wholesale funding should the need arise, as well as our funded assets, financed by equity, customer deposits, and longer-term debt now stands at 97%, which is very healthy. On slide 16, you've got your shareholder returns. Given our growth in profits, that's translating into higher returns on equity and return on assets, and that's continued to edge upwards. Our EPS is pretty sound on the back of the profit results that we've generated without having to raise more equity. And as Mr. Chia said, we are still on track to deliver the expected dividends out of it. On slide 17, we are positioned for Bank Negara's Basel III guidelines. And Bank Negara came out with the guidelines recently, which have largely reaffirmed what the global requirements are for Basel III. There were some early speculations about whether Bank Negara might take a more or less conservative stance, but given the health of the banking sector in Malaysia, Bank Negara appears to be relatively comfortable with it and have just simply embraced most of the Basel III rules as is. And that means that our common equity Tier 1 ratio in particular is very sound. And if you take a look at a couple of new ratios which we put in around double leverage and balance sheet leverage ratios, both including and excluding off balance sheets, they're all well within the expected outcomes from Basel III. So on the capital side, we're very comfortable. The one issue that Bank Negara are yet to discuss with us is around the countercyclical buffer, and as that emerges, we will be in a position to deal with it as more guidelines emerge in that space. In terms of profit growth, I think we've maintained our expectation that we went to the market with at the end of the first 6 months, a profit growth of around 10 to 12%, with a slowing trajectory compared to the first half of the financial year. And that's largely a function of the fact that, one, we've had very strong trading profits, which we said cannot be repeated into the second half, as well as typically seasonally second half is slightly slower for us, and indeed for most of the industry compared to the first half. And so we're still maintaining the profit guidelines at this point in time, guidance at this point in time for the full year. In terms of our medium-term aspirations, I think as we come to the 75th percentile or percent mark for the financial year, we've now got 2 separate years, one for the financial year 2012, where we've given a set of figures that is our estimate of where we think we'll end up with for the financial year, largely consistent with what you've just heard me talk about. In the next 2 years beyond that, as Mr. Chia said, we will be a tad more cautious in the shorter term, and hence those numbers are slightly lower than what we had previously guided the market to expect. But this is one of those things where things could turn well, or it might be the tipping point where things go down. Notwithstanding the fact that our guidance still is around the 4% mark for the short term in terms of GDP growth, the profit expectations might have to be slightly lowered as we turn cautious into the next 6 months in particular, 6 to 9 months in particular. So in summary, as you heard Mr. Chia start the presentation with, we've had the first 9 months results producing good sound profits and profit growth. We will stay focused on growing our sustainable non-interest income and ensuring that we're focused on the right kinds of deposits, the right composition of deposits, and our loan scope will continue to target profitable and viable segments. The conditions we'll expect to be more subdued in the near term, given a combination of both global and local events. But ETP does provide for some opportunities that we are clearly on the lookout for. You heard Mr. Chair talk about continuing to invest in the infrastructure, particularly on governance and risk disciplines, which we will not take the eye off. Our strategic partnerships have been and will continue to be a source of a differentiator for us compared to any other bank in Malaysia, and we believe that connectivity will help us to grow, to continue to sustain growth out into the future, whether it's the banking part of it or the life insurance and general insurance partnerships that we have. And last but not the least, cautious of the short-term outlook, as you heard Mr. Chair talk about, with some potential downside risk, but we, have to the best of our abilities come out and give you a sense of what we expect the business to do. On that note, I think it's formal part of the presentation is done. It's Q&A.
We will now open the floor for questions and answers.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. If you wish to ask a question, please press star followed by 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press the pound or hash key. Your first question comes from Harsh Modi from JP Morgan. Please ask your question.
Hi, good afternoon, gentlemen. I had a few questions. First one is on margins. With the LDR now inching up even higher, what do we expect margins to do for the 18 months?
LDR. Look,
Cash deposit ratio has probably reached a peak. So how do you expect that to impact margins overall?
Yeah, look, our strategic target that we set for loan deposit ratio was 90% plus or minus 2, and we continue to operate around those parameters that we previously communicated to the marketplace. It looks like more Malaysian banks are getting towards our strategic target, having run at much lower levels. We have raised a large quantum of stable funding over the last 2 years to give us a headroom to not outcompete other banks in Malaysia at the short end of the curve. Notwithstanding what I've said, we do continue to expect margins to be under pressure, and we previously said expect around a 10 basis point contraction. At this point in time, there's no reason to change that guidance.
Right. And is it more of a funding which is an issue, or rather funding cost which is pressurizing the margins, or is it the asset yield which is a bigger problem?
Look, on the asset yield side, there's one particular portfolio which has been a problem, which you've heard us talk about, which is mortgages and the pricing for mortgages. And on the deposit side, the short end of the curve for both wholesale and for some aspects of retail continues to be very strong. So it's a combination of both. But if you take a look at slide 11, Harsh, where we've talked about our cost of funds and what's happened Q and Q, you can see that we've been able to manage that with only a 4 basis point increase in the cost of funds between the second and the third quarter.
Right. Right. Okay, the other thing is on asset quality. It seems like this quarter, the guidance on asset quality seems to have done very cautious. Is this a general macro concern, or do you see anything in particular in your portfolio, any red flags which make you so cautious on asset quality?
Look, maybe we've got Andrew Kerr, our CRO, here as well, so maybe I should just hand this across to Andrew to just have a quick answer to that.
Thank you. Look, there's no red flags generally in the portfolio. It's more just cautious about the growth rate and being more selective on what we grow with. So until we get a bit more clarity on global events and just impact on Malaysia, we're just a bit more cautious in the growth we take. Asset quality is holding well, and the pipeline of issues that we look at that are higher risk is also quite stable.
Right. So this is purely a top-down global event sort of worry, rather than anything particular you are seeing in your portfolio.
It's the spillover impact of global events on Malaysia and what that might do to the overall economic situation and sectors of the economy. So it's more about just being cautious around that until we get better direction of global events. It's not saying we won't grow, and we have strong risk appetite in certain sectors, but there's some we're more cautious on.
Right. So is it impacting your balance sheet positioning meaningfully? Is it impacting your ALM in a particular manner? This seems to be a more broader
it's a risk appetite.
Organization-wide worry.
No, it's more about risk appetite and just being a bit more cautious in the current circumstances. And as we get clearer direction on global economy and impact on local economy, our levers will change accordingly. At the moment, we're just being more cautious about growth. And also the risk returns on that growth. So we've mentioned one sector where we like to grow faster, but we're a bit more reserved given the economics.
Okay, final question from me, a bit more detail on this asset quality. What, in your view, or which segments of your portfolio are at bigger risk if global events kind of turn out to be more problematic than where it seems right now?
For Malaysia, I mean, generally, being a reasonable exporter, you look to the manufacturing sector, specifically in some sub-areas such as manufacturing of furniture and electronics. We expect reasonable growth, but in those sub-segments they've been impacted more than others, so we're more cautious in those particular sub-segments. Generally, property goes with the general direction of the strength of GDP, and so it's another area that you just look at cautiously in terms of which pockets you want to grow in. At the moment, Malaysia still is performing well from a macroeconomic issue, but the growth forecast of 4 to 5% will be under pressure depending on the impacts overseas. We still expect GDP growth to be positive, but with a dampening impact, that will dampen certain sectors more than others, and we're more cautious in some segments.
Got it. Thanks a lot.
Thank you.
Your next question comes from Chin Tay from Merrill Lynch. Please ask your question.
Hi, good afternoon, guys. Thanks for the call. Just one point on the NPLs. I noticed there's big increase in the mining and quarrying NPLs quarter on quarter, whereas at the same time I noticed that the wholesale NPLs actually went down. Was there any change in terms of the classification of some of the NPLs in terms of sector-wise that caused this?
Chin, we're not quite sure about that one. Can we take it in advice and come back to you?
Sure, thanks. And the other one is, I noticed, I think as far as the Q-on-Q comparison is concerned, the quarter numbers definitely showed greater momentum in the loan side. But I noticed two segments actually was quite large, education and health, and also in terms of mining and quarrying. Were there specific sort of big ticket loans that you were seeing in that quarter, or nothing specific in terms of the direction?
Look, that should be nothing specific actually. I mean, it's just a matter of the way the transactions sometimes come our way or we go after. So Q&Q is very, very hard to predict at the subsegments of where we lend to.
Right. Final question on the non-interest income and specifically investment banking outlook. Will you be more cautiously optimistic or optimistic in terms of the outlook for at least for the final quarter and the remainder of this year?
Well, I just think, I mean, we are optimistic in terms of the final quarter. I mean, we do have pipelines coming on. So what we achieved in the last 3 quarters, we were able to repeat that in the 4th quarter.
Right. Thank you.
Thanks, Sing.
Your next question comes from Kawing Lu from HSBC. Please ask your question.
Hi everyone, thanks for the call. Just 2 quick questions from me. So I'm not sure whether you went through this earlier, but just to check, your margin improvement during the quarter, I'm looking at the slide right now. Funding cost was actually flat and margins actually went up. Can you, reiterate why there was an improvement in asset yields again?
Yeah, look, it goes back to the trade-off that we said we would do between loans growth and going after margins. We, as I said, we surprised ourselves and the market by the margin reduction that we, had in the 1st quarter of the financial year. And when we did that, we said we are going to actively trade off loans growth versus margins. And if you take a look at our loans growth, for example, we've been growing at around the half the industry average for the 9-month period. And we've done that consciously, but ensuring that what we bank gives us better return on equity.
Okay, so that means it's actually the yields on your lending portfolio that improved. It's not from your securities portfolio or anything else?
No, remember again I said, look, in the securities portfolio, Calvin, we actually sold down some of the higher yielding portfolios in the first 6 months to take it off the table, and that gave us some large trading gains in the first 6 months as well. So it's not from the IFS portfolio.
Okay. My second question has to do with deposits. I noticed your CASA went up a lot, more than 1 billion, I believe, during the quarter compared to the 3rd quarter. And I think it's the strongest amount of absolute growth you've seen. Can you share with us where that came from? Is it primarily business deposits? And were there any changes in the cost of these deposits? And what type of, is it transactional in nature?
Yeah, look, I mean, if you take a look at some of the backup slides, retail, has grown over the 9-month period, page 32. Retail has grown its CASA at 17%. So, and the rest has come from both business banking and CIB. Now, business banking went backwards, but CIB did well. In particular, the area where we've grown our current accounts and savings accounts is coming from the newly created transaction banking division that we product unit that we set up about 9 months ago, which continues to make inroads into our corporate institutional base to get us, and business banking space to get us more transactional-based accounts. To an extent, they are better priced than the retail CASA, to be fair, but it still gives us healthy margins.
Understand. So the majority of the increase actually came from business deposits and is transactional in nature?
Correct.
Got it. Thank you.
Your next question comes from Khairul Rifai from UBS. Please ask your question.
Hi, thanks for the call. You mentioned something on mortgage pricing. I was wondering maybe you can give some color on the level of competition in the auto segment and the corporate segment as well, versus, let's say, 3 to 6 months ago. And my second question, I mean, you mentioned earlier on the earlier part of the presentation on the financial sector master plan. Can you share your views on which area do you think offers the best opportunity for you?
Yeah, look, I'll touch on the auto financing side, the high purchase, as you called it, Cairo. On the HP side, look, generally speaking, margins have continued to hold. There has been increased competition for some segments within that. Some of the car segments, with particularly the non-national car segment, where competition has meant that the margins are okay. It could be better, but in the rest of the segments, margins are still holding and reasonable for us on the HP side. So outside of mortgages and retail and deposits, generally speaking, across the board, I think margins are generally okay. On the corporate side, I was just going to give it to Mr. Chia to...
Well, in the corporate side, of course, the rates are returns are still there. But we do see increasing competition. I see, I'm fully aware that the bigger banks are very strongly in this corporate and institutional banking business. We do see margins do get eroded. So I think that is going to likely to be the norm going into the future, you see.
Yeah, and kind of the key for us then is trying to cross-sell and get the non-interest income related activities from those customers that we have built relationships over time with.
Okay, thanks. On the financial sector master plan?
Well, you know, the financial master plan is a very broad framework actually that the central bank will drive to the year 2020. It touches quite a number of aspects, but largely, of course, if you look at it, one of the key things is that, of course, they are looking at towards new products, and also particularly also in terms of in consumer protection. That is very strong in that. So, but as far as for the bank is concerned, of course, we find that the new products that we hope to take advantage of, the number of them coming up there. You can look in terms of private equity business being dealt more, private pensions, and provision of wealth management, and also in terms of the market business in particular. There's more relaxation in terms of foreign exchange, business management. So there's quite a lot of things related to that. And hopefully, of course, as if you now see the last budget, they are encouraging the establishment of regional treasuries. As well, this comes to support the development of regional treasuries. And I believe there's also a topic in terms of insurance to cover things like oil and gas industry, largely now being outsourced to Singapore, and also in terms of trading in terms of oil and gas into the Malaysian side. So that quite a number of things down there. And these are all just being announced, so we will look towards how to get that into our capabilities as well.
If I could add, Mr. Chair, I think the AmInvestment Bank, as you well know, is one of the leading investment banks in Malaysia. Very strong on the advisory side and also on the corporate finance side. So on our capital markets and bond issuance and sukuk issuance, we're a major player, and we're very confident of getting our fair share of the mandates.
Carol, some of these thoughts that we have is actually on slide 48, which we have actually highlighted some of the new opportunities to this financial sector blueprint in our presentation deck.
Yep, that's it. Okay, thanks. Just one last question on the responsible lending guidelines. Have you seen any impact to flows or pipeline on the loans growth side?
No, look, again, responsible lending guidelines are very important to any country, including Malaysia. They're really putting in place practices we followed previously, generally speaking. The slight tightening by Bank Negara, ensuring that everyone has documented practices, is encouraging and welcome. We're very confident with our own position and our ongoing protection of our own customers. We don't see any material impact, bottom line.
Okay, right. Okay, thanks.
Your next question comes from Kawing Lu from HSBC. Please ask your question.
Hi everyone. Sorry, just a very quick follow-up question. Just want to touch back on asset quality again. You mentioned that there's no visible signs of stress on your portfolio right now, but the caution is basically you're being a bit more cautious simply because of macro events and how that's panning out. I'm just curious, have you run some numbers to see on a worst case basis if macro events do turn out quite badly, how your worst case credit cost could actually evolve from what you have been guiding?
I think this is one, what's the American term? The fifth. I'll take the fifth on that one. After cracking the joke, by the way. I mean, look, as Andrew said, look, our asset quality generally holds across the various portfolios. We do put it through two stress scenarios. One is a 1 in 7 event, the other is a 1 in 20 event. And we've linked that back to a set of actions that we would take in the event those eventualities come to pass. And really, the extreme event, which is 1 in 20, 25, is simply meant to give us a design on what levels of capital is required for us to still be a going concern. And in the 1 in 7 event, it is to ensure that we are not only just a going concern, but we can carry on normal course of business with the amounts of capital we've got. And those appear to suggest we'll still be okay under those stresses.
Okay, thanks.
Thanks, Harry.
I think the point to note there clearly is that in Malaysia and other Asian countries, the financial sector is probably as strong as it gets, so to speak. We're in very good shape. We have the ability to absorb shock. We're constantly reviewing our risk appetite and our portfolio mix, and you've seen that in terms of our growth in the current year. So it's not just doing a stress test and how do we fare, it's how we fine-tune our risk appetite settings along the way, which we're continually doing. So that hopefully we never get to the peak of the impact of those two stress tests that we talked to, that we're dynamic along the way as information in our portfolio is impacted.
I'm hoping for that too. Thank you.
Your next question now comes from Harsh Modi from JP Morgan. Please ask the question.
Hi guys, a follow-up. This was on DCM, the debt capital market revenues. You guys have had a pretty good franchise. But specifically from this ETP projects now getting launched and all these guys needing capital, how much of that is coming to your way on both loan syndication and debt? And overall, how does even broadly, your IB pipeline look from here?
Well, if you're looking at the ETP, Aqua ISCO project by project financing, if you look at the first big one that comes out, obviously it has been shared by a number of banks. I'm pleased to say that I think we are one of the 4. Each of us have equal stake in raising the funding on this one. So we have the capacity to take, and we also the capacity to distribute. So that's where even at the last 9 months, you see that our share of the market is strong, both in Sukuk and non-Sukuk market.
Right. And how does the pipeline look other than this one project going into, let's say, next 6 to 9 months?
I mean, we address this issue regularly, and I would like to say that the pipeline is strong over this period. We don't go for one particular project, but we look at those that where we have a strong relationship. We make our pitch on that, and generally we are pretty successful.
Okay, thank you.
Your next question comes from Wee Teck Bo from AmLife. Please ask the question.
Hi, just 2 questions. My first question is related to your due diligence progress in acquiring a local general insurance company. I was just wondering where are you getting on? How are you getting on that at the moment?
Well, that one is still ongoing. So I won't be able to share any highlights with you on that.
Is it very likely that you complete the transaction?
That we don't know yet. I mean, okay. It's besides the due diligence, we are subject to regulatory approval as well.
When do you think the whole thing will be finalized?
I can't give you a timing actually. Although the SMP has a certain period, and as you know, this period are extendable if they are being needed actually.
Right. Okay. And my second question is related to your markets division. Obviously, it's been a key growth driver for your current FY. And I think I should mention that some of these income trading profits will not repeatable in the next few quarters. So I'm just wondering whether this division will continue to be your growth driver, or do you expect this division's growth to slow down and it will be taken up by another division?
Look, what we've had is a particularly good first 6 months of the financial year. So if you think about three components within the markets business, we've got FX and derivatives, which we set up as a new business around 3 years ago. And on slide 36, you can see that that's contributed around 50 million to the overall profit outcomes for this division. A large part of that, over 85% of that, comes from flow business activities, and it's one where we would expect to see growth as we naturally offer the products and services that we built out to more of our customers. Within the fixed income part, there are two elements to it. One is the underwrite business and the sell down of that, and some of the sell down profits are reflected in the markets business, and the balance is reflected in the investment banking business. And you heard Mr. Chia talk about the pipeline being pretty sound out there, and that should continue to hold up good for us over the next 6 to 9 months. That leaves the third element, which is the trading element, particularly from the available for sale portfolio, where we said we've lightened our position in a falling interest rate environment, and in that it's that component of it that is not repeatable entirely to the extent that we had in the first 6 months. But we're still comfortable that as the yield curve in the marketplace changes shape, which we do expect over the next 12 months or so, with increasing demand for debt issuances, we should be able to pick up more of that and then hold that for a potential sell down later in terms of riding the cycles and the volatility in the interest rate markets. So generally speaking, we're still comfortable that it's a growth business for us. The pace of the growth in the near term may not be as sound as it's been in the first 6 months of the financial year.
Okay, so my final question is, do you have any loans growth target for this year?
Look, generally we've always said loans growth target is around the system plus or minus 1 to 2%. But as you've heard us talk about, the near-term outlook is one where we need to be a little more cautious, and preserving our margins will be given a higher priority over growing our lending, our loans. Would suggest that you'd need to take probably a portfolio view on it across on the income side as opposed to just the lending view. We would continue to expect to underperform the marketplace on average on loans growth, but outperform on other aspects of what we can do as a cross-sell activity to it.
Like on the non-interest income side, basically?
That's correct.
Okay, thank you.
The next question comes from Chi Wei Long from ELSA. Please ask your question.
Hi, Chi Wei here. I have two questions. Just one question on the, I noticed that the trading securities has actually jumped by, I think, 77% year on year. It said that you are taking a position to increase your holdings there in anticipation of gains. Is there any risk on that portfolio? And secondly, on your loan loss provisions, I noticed that the individual allowance came down, but the collective allowance actually went up. So I'm just thinking, is there a shift in terms of like a classification for the reason for the increase in collective assessments?
I mean, the first one is a simple one. Our held for trading portfolio, the quantum of assets in that portfolio increased as a result, but the bulk of that portfolio is now in short-term assets. And the idea is that we believe that interest rates are quite low at the moment, and it's probably expected to stay low in the near term given the global issues. And hence we've shortened the duration of our assets, and the surplus that we've got is held in the short-term durations. And we've also lightened, as I said, the AFS portfolio in the first 6 months, and that amount has probably again gone back into shorter duration traded assets. The second question around IP and CP, I mean, on a quarter-on-quarter, it's very, very hard to predict what the IP is going to do. You heard us talk about a large account in business banking for which we took some provisions in the previous half. We've taken some this half, but it's nowhere in the same quantum. And again, we've taken that more as a collective provision as opposed to an individual provision. So the composition is one that will chop and change quarter on quarter, but the trajectory of provisioning is still within our broad expectations.
just a follow-up from that is, what do you think is the impact on your provisions with the full implementation of FRS 139?
It's work in progress. I think you've got to wait for us to come back with our first quarter results in July, August, when we come with it. It's still work in progress. The models will need to have, we'll need to refine a bit more, validate it. Bank Negara rules need to come in. There's a whole host of steps we need to take to get to that outcome. So it's work in progress.
All right, thank you.
Your next question comes from Julian Chuang from Nomura Securities. Please ask your question.
Hi, thanks. Just a question on your medium-term outlook. You have lowered your growth to 10 to 14%, and your ROEs are also tempered slightly downwards. But I noticed that your cost to income is still maintained at 42, and NPL ratios at between 2 and 2.75%. So where do you think the downside is coming from?
Well, in a period when GDP growth is likely to soften, I think you've got two issues potentially facing you. The first one is your revenue growth may not come in as strongly. And secondly, we've had a brief chat about asset quality potentially impacting us, but it's the headline that we're more concerned about than asset quality at this point in time. So between the two, we believe we can still manage the broad asset quality ratios around the 2 to 2.75, but we're more concerned about being able to generate revenue growth in a period of softening demand.
And the cost to income is also impacted by our CapEx program, which is coming into play. So the slight uptick in cost to income is driven by investment in our overall infrastructure. So when you get a bit of pressure on your revenue and you're still spending on the infrastructure upgrades, that just creates a little bit of tension during that period.
Okay, great, thanks.
Yeah, and Julian, if I may add, at 42%, I think we're still in the upper quartile as far as efficiency is concerned compared to our peers.
Sure. Yeah. Thanks very much.
Once again, ladies and gentlemen, if you wish to ask a question, please press star followed by 1 on your telephone and wait for your name to be announced. Your next question comes from Matthew Smith from Macquarie. Please ask your question.
Yeah, hi, thanks. I came in a little bit late, so if I'm asking you to repeat, just go ahead and take the fifth again. But I'm looking at slide 37 on the life insurance side. It works out to, well, it looks like an 18% decline but also a 38% decline in gross written premium. And I can read the slide, and it says on the check bullet point 2, it says providing enhanced support to better performing agency force is one of the things you want to focus on. But could you be a little bit more specific about what that means? Is it the agency force here that's the issue, or is it more a case of us just waiting for the bank insurance products to gain traction?
Look, it's more the agency side is the short answer, Matt. What we've had is a relook at the number of agents we've got, the ones who are more productive than others, and the types of products they've sold for us. And we've discovered that there are some low value add products, high capital, highly intensive in terms of capital requirements, that we believe is not one that we should be selling more of as we've done historically. And that's a strategic shift that happened about 12 months ago. It's taken us a while to pull the trigger and work our way through ensuring that what we hold on to are the agents who are more or better performing or more productive and giving us the right kind of products at the moment. On the banker side, we are continuing to see better traction in terms of getting an increasing portion of that coming out of the bank assurance channels for us. But we've still got a big upside as we get the business model working a lot more collaboratively and in a more aligned way. We are in the process. We haven't had a CEO for this division now for a little while. We're not that far away from making an appointment, and that will ensure that we get life insurance moving into the next stage of growth for us.
Great. Thank you very much.
Once again, ladies and gentlemen, if you wish to ask a question, please press star followed by 1 on your telephone and wait for your name to be announced. Once again, if you wish to ask a question, please press star followed by 1 on your telephone and wait for your name to be announced. There are no further questions at this time. I would like to hand the conference back to today's presenters. Please continue.
All right. Well, I think that's the last question, I suppose. So I would like to thank on behalf of AmBank all those who called us in, and we would like to invite you to visit the website to have a look at the video of the full presentation and other details that have been put in the website. Thank you, everyone, for dialing in, and happy Valentine's Day on behalf of AmBank.